Alrighty, so let's look at a couple examples of what are typically on the lower end of the spectrum of probability trades. Okay, so in this instance, the 4-hour chart, let me just make this a little bit more obvious. So here we can see that the 4-hour chart was bullish, then it shifts bearish for a bit, and then we switch bullish, but we don't really get a swing pullback until all the way up here, which ends up meaning we have this really big swing range, and then eventually where we've brought the price action to, we eventually shift bearish. Okay, so the swing structure is bearish. Zooming in a little bit to kind of the more relevant price action, when we have that, we can just see how clear that strong bearish order flow is with the internal structure. Tried to break the high, swept it, and then we just have traded off. So just looking at the last month or so of price action, it's just heavily bearish, right? I think that's all pretty obvious for us to agree on. And then we can zoom into this most recent 4-hour range. So yes, after a 4-hour break of structure, we can expect that deeper 4-hour swing pullback. And obviously the internal structure will shift bullish to facilitate that when it's ready. But when I can see just this for the last month or so on the 4-hour chart, we're just selling off and selling off and selling off. Why am I going to fight that, right? The high probable direction is still to the downside, right? Supply is being respected. We've just had an IBOS there. We've pulled back up into the EQ. We've mitigated that level of supply. We've started to push down. So, on the balance of probabilities, shorts are to the downside. Now, that said, before we even jump down to the medium time frame, we can see it's probably going to be ranging a bit because as we can see, price pulled back into the supply zone, it's pushed down, it's just wicked this low and then pushed back up, and then price is just trending around. So when that happens and you see a large doji like that, you can already know before you go down a time frame that we're ranging, it's a little bit indecisive, and it's not so great. So the M15 swing structure in this instance, we were bearish. We just about shifted bullish here. We barely closed above that recent high, and then we shifted bearish again. After a boss, what we can expect? We can expect an M15 swing pullback. The internal structure then shifted bullish here to facilitate that swing pullback. We did actually have some volatility where we had a little bit of an internal pullback here. And then during the news, price shot up, caused a bullish IBOS, mitigated deeper into that 4-hour supply. Then we got the bearish IBOS. So then at this point you would think, okay, M15 swing pullback, we pull back up into 4-hour supply, bearish IBOS, now we're expecting the weak swing low to go, which happens by about 0.1 pips, okay? We failed to close below it, sweeping that liquidity, and then we've just pushed back inside. So technically, the M15 swing is bearish, this is our range, and technically that was our last bearish IBOS here, right? Because that was that last pullback and then the break. So technically, that's our internal high. This is our internal low and swing low, and that's our swing high. So on paper, the swing is bearish, and the internal structure is bearish, and the 4-hour internal is bearish. So you would think sales are pretty high probability still, but in reality, this is where I just define this as a range. We've swept the swing low, we're kind of aggressively putting back in, and really we're just changing between this high and this low. And very often when that happens, a lot of times in my pre-market analysis, if you've seen me guys share it, I'll basically just be like, we're trading between this high and low, and until we break out of this high low convincingly, trades within here are low probability. And really this is when you want to go to your phases cheat sheet and just go, right, no clear immediate intentions, stay out of the middle. You want to long in the bottom 33%, so the section down the bottom, the orange section down the bottom, or short in the top section, all right? And the best thing to do is literally just wait for a breakout, like I said, and try not to get caught out. But if you do get sucked into trading it, this is kind of where I want to show you that there will be winning trades, but there'll also be a lot of losing trades. So you kind of have to take them both on the chin if you don't want to do it. Now, one argument for bullish is that we did sweep the low, and since then, we've had quite a big V-shaped retrace, and we're starting to form that bullish internal structure within the internal range. So you could argue that, okay, potentially we are going to see that to the upside, right? And this is where you can kind of get led into those positions that can kind of look good initially without really kind of, saying to yourself, well, I'm in a range, so I don't really want to get sucked into these positions, but essentially viewing that as your internal range. Okay, the session's open. This is the London session around 7 a.m. UK time. So it's like, are there any good POIs to trade from? Got that zone there. This has all been mitigated. You got this range within here. It's probably like really our extreme within the range. Like this has been mitigated. This is all just slow corrective price action. It's a Monday as well, which isn't great. So yeah, so let's probably price forward and see if we can get a mitigation of a level to try and look for longs, right? If we were looking for low probability trades, kind of chopping around. potentially could justify it as like the sell to buy range if you wanted to. And yeah, the M5 is the entry time frame I'm using with this model, as you guys know. So let's say we wanted to trade from here long. We've had our first tick in the box, which is our POI mitigation. Okay, if you want to use that larger range I just drew on. Second thing, have we had a strong liquidation in the pullback? Well, this low did not break any structure, so that's not a strong liquidation. Now we've had a fake break. Let's see if we can get a liquidation of this low, and we can potentially get involved. We don't get it, and then we push up. Okay, so we pushed up, no strong liquidation there. That zone's been mitigated. Let's have a look at the M15. So we pushed up again. We failed to take out the high, so that's not a great sign. But you could look for the demand. Sometimes these will play out, kind of following that demand chain and see if we'll push up again. But can you already see now, we're in a range. You know, I've kind of explained that hopefully in detail. Not really want to be trading within here. I mean, technically, you've even got this massive supply zone here that did cause a wick break of the low, but you know, it's huge, kind of just ignore zones like that. This low has now failed to cause a counter body break of the high. Like, this is where I just want to advise you guys, just stay away. Trade might play out, but is it really worth it? Well, you know, let's look at some low probability trades if we come in. So we mitigate the demand zone, looking for strong liquidity to be built. So nothing's going on yet. We're just pulling back. Okay, finally, so this low breaks this high. So an M5 chart, which means now we can potentially have some strong liquidity below this low. So then you would set your alert and see if we can get a liquidation of that low. Okay, your alert would go off. We've now liquidated this low, right? So with the LC2A rules, the moment that liquidation happens, what do we need to wait for? We need to wait for the candle to finish printing, right? So this is a 115 candle. It will finish printing at 120 because it's a 5-minute candle. So imagine it's 120 now. Immediately, we will place our buy stop order above the high of this candle, give it a bit of a buffer depending on the spreads with your broker, and then we'll put our stop loss just behind. Again, whatever buffer you have decided on in your testing, it will also be dependent on the buffer, with the spreads your broker has. And we're going to aim for 3R, so it's going to be around about 3.3 depending on commissions, okay? And this will be it. So now we're either going to get tagged in or price will break the low of the candle. If price breaks the low of the candle, then we'll cancel our order. Let's see what happens next. Okay, we get tagged into the trade. So now we do nothing. We're just going to do set and forget. It's either a 3R win or a loss. Nothing to do, nothing to do. And then we get stopped out, okay? So just another example, really wanted to show the entry model, but I want to also do it under the guise of kind of, giving you more mini lessons on building the higher time frame narrative, POI selection. Hopefully, if you've been here a little while now, you would have known before we even looked at this that this was going to be not a great trade, right? Even though obviously the title of the video is low probability, you guys can hopefully see range bound's not great. This low failed to cause a candle body close at the high on the M15, etc., etc. Now, let's say you're kind of aggressive and you're stubborn and you just want to, or maybe don't have a good grasp of what is a high or low probability setup. You might go, well, we're still in the M15 POI. The trade idea is still valid because the POI has not failed yet. We haven't traded through it. So maybe you still want to get aggressive and get in long, right? Well, what do we need? We need a new strong liquidation. Well, this low, did it break any structure? Yes, it broke this high. So we've now had another M5 change of character here. So then this can be your new strong liquidation on the M5. Okay, so let's draw that in and bring this back. I'm just going to use this one. Just bring this back one candle because obviously this is when the liquidation happens. So once that candle closes, you need to wait for it to close, remember. Then you set your buy stop above the high, stop loss below the low, depending on what buffers you use, etc., etc. I don't want to keep repeating myself. Hopefully you guys know that bit now. We'll just say 3R, okay? And you would leave it here. Either get tagged in, or if the lower the candle breaks, then you cancel the order immediately. The lower the candle breaks, so you would cancel your order. You would wait for this candle to finish printing. Now, as long as price is still within the POI is still being respected, if you want to still get involved, you can, right? So again, wait for this candle to finish printing, stop above the high, stop loss below the low. Then it looks like you get tagged in first and then price goes down. So depending on your buffer, you might still be in, might still be in the trade. Yeah, I mean, your stop loss should be like a minimum of a pips, 6-2, 7-2, and then you would have been stopped out there if it's tight. Maybe you're a bit looser. It depends on your buffer, right? Again, we'll get into this when we talk about the testing towards the end. But it's a low probability trade and price shops around, and depending on your stop loss, it eventually starts to move to the upside here, okay? So yeah, I mean, the main thing I want you to take away from this is the theory lesson before, where I went through the phases and the general ones which are low probable to try your best to stay out of for the most part. But collect the data in your testing, right? Maybe you want to take every setup, categorize them as low, medium, and high probability, and see how you get on. And if we just look at the M15 and bring it to the next day, okay, to around the London session. Just get rid of this trade. So that potentially would have been a winner depending on your stop loss size. You go, right, we're seeing a continuation of this bullish order flow, right? We have a new strong internal low, like the internal of the internal, potentially if you want to get involved. Even these POIs are just rubbish, right? There's nothing really that obvious in here. You know, arguably like you've got this at the low, but just all of that sell side liquidity behind. Middle of the range, right? We're still within this until we break out that range. Not high probable. And also, where do you not want to be trading? In the middle of the range, just a place to stay out. Ideally, you want to be shorting here and buying down here, not in the middle. But again, we'll do one last position and let's just see. So we get our POI mitigation if you wanted to trade this. Do we have a strong liquidation? No, none of these lows broke any highs. So very, very simple. We just wait for that to happen. Okay, this low breaks this high. So we can then potentially see if we're going to get a liquidation of this level. There we get it. So the moment, let me bring it back so we can talk through it, because it's good to know these rules. The moment the liquidation occurs, right, you're ready to take an entry, but you need to wait for the candle to close. Entry, buy stop above the high, stop loss below the low, again, depending on what buffers you use. Target 3R. Now these two candles, okay, they haven't broken the high to tag us in, and they also haven't broken the low of our entry candle, right, our liquidation candle, whatever you want to call it. So you do nothing, you wait. We either get tagged in or you cancel the order once that low goes. So what happens next? We get tagged in. So now you just follow your management strategy and we go, okay? And boom, another loss because you're just trading in the middle, right? It's just not the place to be doing it. So I think you guys kind of get the point on that. We'll take a look at some medium probability and high probability trades in the next lessons. Actually, before we roll on, I just want to show you one more example, and this is going to be of a phase D trade. So this is essentially where you are trading just counter everything, okay? And it's more of a recent example. So not even going to bother drawing on loads of analysis. This was the trade we were looking at earlier, but we can see just for a long time now that price has just continued to sell off with clear bearish, bearish structure here on the 4-hour chart. And where I brought price back to is we just had a break of the 4-hour swing low. So potentially we can look to trade that 4-hour pullback. But if I zoom into the 4-hour price action, right, we don't have any structural shift to work with. Like we can see even the fractal structure is still bearish. So trying to get long now is pretty damn aggressive. We have no clear and obvious, recent demand zones nearby. So you can see how getting long would be pretty damn aggressive. Even without even doing any long-term, detailed analysis on the M15, we can just see how heavily bearish we are. We had a little bit of a shift of, some structural highs here that would have caught people on the wrong side of the market. We've had a strong liquidation there, but we're still selling off, right? Had a bit of a chop around with news, and there's just no real bullish signs yet. If we even look at the most recent fractal structure, right, when we took this low here, this would be our M15 fractal high. So this low right now has not broken any structure, this low down here. So to buy from here, you're buying from a weak low that has not broken anything, okay? So this is what we mean by like being an aggressive trader, taking those lower probable setups where they're just, we're objective and we list the confluence down. There's not a lot going for this, okay? Now over time, you can get more experience and you can go, right, I'm willing to be aggressive in this scenario because we're expecting the 4-hour pullback. We've already seen a sizable strong liquidation here with early longs getting caught on the wrong side of the market. Since that news, we've kind of been failing to really close below, these lows. We're starting to see bullish pressure coming in. We've seen a V-shaped reaction. We've got all of these Asia lows building in front of this POI, right? So you know what? I'm going to play, we're maybe viewing this as the start of a range before we get that hard time frame pullback. And you don't want to wait for that to occur. You're happy to see if you can hit like a quick long within it. Okay, whilst accepting that this on paper, on the long term, it's not great, right? Because you're trading from a weak low, but you're doing it for those kind of reasons I've explained, okay? So I wouldn't recommend this, but it's just to kind of show you, the possibilities of how you can trade the market ugly. So we've got all of this Asian liquidity building up pre-London session. So let's jump down to our execution time frame, because what do we need to wait for? We need to wait for our POI mitigation, so we get it now, okay? At this point, we've had a mitigation. Now, typically what I like to see is my favorite setups, right? It's price, and it's almost the immediate price action, comes into your POI or at least near your POI, you get the little chalk, you get the liquidation, we enter, and then hopefully, sky's the limit. This is like a range, so technically this still meets the rules, right? This low did what? It broke structure. I mean, there's your immediate chalk there. But this low clearly broke some structure. And also what's great about it, right, is we've got the big sort of Asian liquidity sitting below it. So we can basically view this as our immediate M5 liquidation here. So this is a kind of a good example actually to go through the kind of the small details that you really want to pay attention to, especially when you're backtesting, because it's kind of easy to miss it as you skip through, right? So let's say you wanted to take this low probability trade. What do we have? We have our first thing. We have the POI mitigation. We have the strong liquidation. So the moment the liquidation candle closes, then we can set our buy stop order above the high, right? You guys know the drill about the buffers. And then let's just say we target 3R, right? Just keep it simple from now. Now, we either get tagged in, or if price breaks the low first, then we will cancel our order. Okay, it's a bit hard to tell when you backtest, so we drop down a time frame. Let's see what happened there. Well, we can see that we clearly broke the low before we broke the high. So because we broke the low first, the very moment that would have happened, which would have been at 7:30, we would have cancelled our order, right? So we wouldn't be in this trade because the low of this candle broke first. Once this candle finishes printing, then we can put our buy stop above the high of that, and obviously our stop loss below. Then we get tagged into the trade. So now we do nothing. We just follow our management strategy. Price pushes up again, and then it comes down and stops us out. Okay, so depending on your buffer, you would have needed a pretty big one in this instance. You've probably been stopped out of that trade. Okay, it is what it is. You've taken a loss there. The POI is now still being respected. So technically you can still play this medium time frame idea if you so wish to do so. We've pushed deeper into the EQ of the zone, filling up more orders. Now, remember, the devil is in the detail. Do we have a strong liquidation here? Well, this low caused a bullish M5 change of character when we were in that trade. So this low has broken that high, which then means we have a strong low, which then got taken out. So we've had a strong liquidation. So maybe if you didn't take the first trade, you might go, right, we've swept all these lows. We've now had an immediate liquidation during session. Maybe, you've seen enough to now get involved. Okay, so that liquidation occurs here with the AM candle. Wait for that to finish printing, stop above the high, stop loss below the low, right? And then you either get tagged in or the low of the candle breaks. Well, neither happened. So we leave our order on. We don't do anything at this stage. Then we get tagged in. So now we just follow whatever your management strategy is. And then you are in the trade there, okay? So low probable trade, phase D, 1 loss, 1 win. And there you go. So yeah, just wanted to show you one example, but I would stress focusing more on what I'm going to show you is I believe to be the medium and higher probable trades in the long run. And yeah, until you're a bit more experienced, stay away from phase D, buying from weak lows until you can, have that risk appetite and experience to do it in certain scenarios, or your strike rate will be a lot lower, which is easier said than done to deal with in reality, especially when you're trading significant capital.